You ever look at the Forex market and just scratch your head, wondering how on earth anyone makes real money when the prices are moving by like fractions of a penny? It seems totally impossible, doesn't it? Well, today we're going to pull back the curtain and demystify the exact mechanics of a Forex trade step by step. So, the whole challenge of trading Forex really starts with this tiny little thing called a pip. We're talking about price changes so small, they are a teeny tiny fraction of a cent. So, how in the world do you make a profit from that? This is the fundamental problem every single trader needs to solve. So, yeah, this is the big question, right? If a currency pair moves by some microscopic amount, how does that ever turn into money you can actually spend? On the surface, it just doesn't seem to add up. But the answer is baked right into how the Forex market is structured. And that answer starts right here with the pip. A pip is basically the smallest possible tick up or down in value between two currencies. By itself, one pip is worth, well, pretty much nothing. If you traded just a single dollar, a one pip move would be completely meaningless. So the first puzzle we have to solve is how to make these tiny pips actually matter. So how do we make those little pips meaningful? Well, the first part of the solution is actually pretty simple. You have to trade in bulk. And this brings us to the really important concept of lots. I love this analogy. It's kind of like when you go to the supermarket to buy eggs. You don't just walk up and buy one single egg, right? Of course not. You buy a carton of 12. Well, Forex operates on the exact same principle. You don't trade one single euro or one single dollar. You trade a standardized carton of it. And in the world of Forex, that carton is called a lot. It's just a simple way to measure your transaction size. So instead of placing an order for a random number of dollars, you'll place an order for, say, one micro lot or one standard lot. It standardizes everything. As you can see, there are a few different lot sizes. We've got nano, micro, mini, but the industry benchmark, the big one, is the standard lot. And that is a block of 100,000 currency units. Now, for our example, let's focus on that standard lot because it's the real key to making those tiny little pips suddenly feel very, very big. And this is where the magic happens. By trading that big standard lot of 100,000 units, a tiny one pip move in a currency pair like the US dollar versus the Swiss franc suddenly becomes significant. That single pip could now be worth $6.87. Now we're talking. That's real money. Okay, so we solved one problem. We trade in big lots to make the pips worthwhile. But you can probably see where this is going. In solving that problem, we've created a brand new, very obvious one for most of us. I mean, this is the elephant in the room, isn't it? Most people, myself included, don't have $100,000 just sitting around waiting to be put into a single trade. So how can an everyday retail investor possibly control that much capital? It feels like a massive wall blocking you from even getting started. But it's not a wall. And that's thanks to two of the most important and maybe most misunderstood concepts in Forex: leverage and margin. This is the amazing tool that makes the entire market accessible to pretty much anyone. Honestly, the easiest way to get your head around leverage is to just think of your broker as a sort of bank. They agree to front you the money to control a huge position, like that $100,000 standard lot we talked about. You don't have to put up the whole amount yourself. And that's all leverage is. It's the power to control a lot of money with just a little bit of your own. Now, in exchange for lending you this power, the broker just asks for a small, good faith deposit to secure the trade. And that deposit has a special name. It's called margin. Okay, let's walk through a super simple example. Let's say your broker offers 100-to-1 leverage. You want to trade that big $100,000 standard lot. To make that happen, the broker just needs a 1% margin deposit. So you put up just $1,000 from your account, and boom! Instantly, you are in control of the entire $100,000 position. It's incredibly powerful stuff. Now, this is so important to understand. That $1,000 is not a fee. It's not money you're paying to the broker. It's a deposit. It's your money, and it's just being held as security. The second you close out your trade, you get that deposit right back, plus or minus whatever profit or loss you made. So now we've got all the pieces of the puzzle. We know we need to trade in lots to make pips valuable, and we know we can use leverage and margin to control those big lots. So let's put it all together and see how a real, actual, profitable trade gets calculated. All right, let's run through a sample trade. We decide to buy one standard lot, that's 100,000 units, of the US dollar against the Swiss francs. We get in at a price of 1.4530. Then, a little while later, the price has climbed to 1.4550, and we say, okay, time to take our profit and close the trade. First things first, the simple subtraction. Our exit price was 1.4550 and our entry was 1.4530. The difference is 0.0020. In Forex speak, that means the price moved in our favor by 20 pips. A great start.
And hey, we already figured this part out, right? We know that for this specific trade, a standard lot of USD CHF, each and every one of those pips is worth $6.87.
And now, for the final easy part. We just multiply the number of pips we gained, which was 20, by the value of each one of those pips.
And there you have it, a total profit of $137.40. That's it. That's how pips, lots, and leverage all team up to turn a tiny little fluctuation in the market into a real, tangible financial result in your account.
Okay, one last quick but very important detail to keep in mind is something called the spread. You can think of it as a small built-in transaction cost. It just means you always buy a currency at a slightly higher price, called the ask, and you always sell at a slightly lower price, called the bid. It's just a factor you have to account for when you're calculating your final net profit.
So, you see how powerful leverage is, right? It lets you control a massive position, but that power is a double-edged sword. It can magnify losses just as easily as it magnifies gains, which leads us to our final and maybe the most crucial question of all. Knowing that your margin deposit is on the line with every trade, what is the single most important thing you can do to protect that capital and make sure you stay in the game? Something to think about. Thanks for joining me.